So hello everyone, I see the first few people joining, so we'll just wait for a few more minutes, maybe 1 more minute until 4 o'clock. That's when we said we would start. So that way, the people that join a little bit later won't be missing too much here. So just give us another minute and we'll be ready to go. All right, everyone, I think it's 4 o'clock, so let's get this started. Again, hello, everyone. Second time around this week for Freddy and me to be speaking to you. But we had some really good feedback for the video we did on Tuesday. And with continued market volatility, we kind of wanted to address a few more things and get to any of the questions that you as our clients or not yet clients have for us, especially in those times. So I think this is a really good forum to do that, to address everything. So throughout this kind of Facebook Live event here today, feel free to ask questions through the comment section on the side or below the video for you, and we'll definitely try to get to them all. So with that being said, Freddy, I don't think we have to introduce ourselves this time again, but let's start by maybe what's on a lot of people's mind is basically a lot of people talk about, oh, it's a bear market, then other people are saying it's a correction in the markets right now. What's kind of your opinion? And maybe explain both of them, like what is the difference between the two of them, right?
Right. It's very easy to get confused in times like this. First, what is a correction? A correction is actually a very common and they are usually rapid, sudden declines in the market. When you least expect it, they happen. They're intense and they're emotional, such as the one that we are having right now. And it's generally defined as a decline of between 10 to 20% of the stock markets. Now, I would say that we haven't seen a correction for the last, it's been a while since we've seen a correction.
I think, well, January of 2016, right?
Exactly.
It's a long time. So
I'd say since Trump's victory, we haven't seen any corrections. It's quite amazing that the stock market has had an 18 months bull run without a single month decline.
Yeah.
The unusual thing is the last 18 months. We are too used to a very comfortable environment. Throughout our career, I think Philipp yourself, you mentioned, in a bull market, a lot of this, it's very, very common to see corrections of such magnitude. You generally do not overreact to it because they're very quick and they're very noisy environment. It's very, very hard to react to. But a bear market is different. A bear market starts with a whimper. It's a whisper. You don't even know it exists. You start losing 1% in a month. And over 6 months, you suddenly realize you have been losing money every single month in a small way. It's steady, gradual, quiet, and then you go, oh my God, it's a bear market. So what's the two difference also means two different sort of reaction for us investors, for us long-term investors. What it means is correction, we do not react to it. Let dollar cost averaging, work in your favor. Of course, don't borrow money to invest. We always believe in good practices. But in the bear market, it actually means that you have ample of opportunities to start making adjustments to your portfolio for it. And that is what StashAway does best, because we look at economic cycles, economic data, we adjust portfolio according to the what the economic trends are saying. So those are things that we would prepare you for. But a correction is something that we would say you do not want to react to.
Yeah, and we already talked about, that was kind of like my next point that I was trying to make is actually, or talk about, is taking it up to a higher level and talking about economic data, right? Mm-hmm. So we at StashAway, we look at economic data on a daily basis, and as many of you know, especially also the people that already have invested with us, one of our main features is, or like what we're really proud of building is what's called the economic regime asset allocation model. which this is all built on, and that's also how we really much differentiate ourselves from some robo in the US, some of the biggest ones, which are very static in their approach of investing, but we are not. Maybe from an economic data standpoint at this point in time, there was a lot of economic data coming out the last couple of weeks, right? So that's a little bit of an update of what we see and how we interpret those data.
Right. If we look at just focusing on the economic data, they're fine, they're doing well. In particular, one of my favorite is the Conference Board leading in the economic indices. It's free, you can search it online on their websites. They provide it for major countries in the world, including US, China, Australia, UK, Europe, and so on. What you realize is the latest economic data prints has improved and accelerated. So it means that the pace of recovery is growing. And another funny thing that's going on in the market now is we're finally starting to see some wage growth.
Yes.
And now we are worried about wage growth because it's inflationary.
Yeah, and that's something that's been in the news for this whole bull market, from the beginning of the bull market actually. It's in the news in the US at all times, and everyone is complaining about, okay, the rich are getting richer, but the workers are not getting any more wages, so there's no wage growth. So on Friday, last Friday's economic data showed for this first time that there was a significant growth in wages. So now, and all of a sudden everyone is upset about it, which they thought for years that they were upset that they didn't happen. So it's kind of like this offset right now, right? Like with the data.
Which brings me to the point that, the media, I do thank the media for being an instant, real-time provider of info, and it tells us where the consensus feelings are. But the media is not designed to be looking at what's next. We always need to use a forward-looking approach to looking at markets. So, and again, media may also make things a bit more sensational. So my advice is stay focused on the economic truth and do not overreact to any headlines. What we have here is a situation of market sentiments, right? In January, we have, actually December and January, we have heard a lot of bankers were saying they were so busy except for Christmas because all moms and pops are fear of missing out, as I've said before. Everybody's afraid of missing out on the bull run. Everybody has invested. So who's left? That's my question, right? Now, this is a classic short-term case of a reaction to a classic pullback when everybody has bought. So again, sentimental is short-term. As long-term investors like ourselves, we don't borrow money to invest. We shouldn't borrow. And this is the best time to average into the market at lower prices. We haven't been able to be invested in growth last year as cheaply as we want them now. So, again, stay true to our investment plans.
Stay true to your goals, right? I think that comes back to, most of our goals and then most of the clients' goals that they put in on our website and in their framework, right, is they're usually long-term. And for long-term goals, you should have a diversified portfolio, but they're long-term goals, right? So you add to them every month, every quarter, every month, week, or whatever your plan might be. But go back and look at your goal and how far is that goal away. And from there, you slowly go back and realize that these short-term bumps will happen, but without them, you wouldn't get the rewards in the long term, right? That's how equity markets and any market actually works, right? That's risk and reward. A little bit more risk, you get more reward. Long-term goals need more risk because they need more reward, right? That's kind of how this whole market thing works in general anyways.
Mm-hmm.
But for StashAway, one other point I wanted to touch on is, because we always get a lot of questions, what about the US Sing exposure, right? And of course, since we started in the summer, the US Sing was moving one way, but we always try to remind people there's a percentage of the portfolio let alone in US dollar exposure for one reason. Do you want to touch on this and actually what's kind of happening with that as well, why we have it?
It's an excellent question. I know that being in Singapore, we're very fortunate to be in a very in a managed currency regime. The honest truth is Singapore is a small open economy. We do import a lot, right? Inflationary pressures from around the world would hit us anyway. The fact that you're retiring in Sing doesn't mean you should only have Sing assets. So what we've done, the way we look at it is that you always need to have some inflation protection. So having exposure to some commodity currencies like Australian and Kiwi provides that kind of hedge. And US dollar, Japanese yen, Swiss franc exposure to assets there provides a risk reduction for you. Because these are funding currencies of the world. Whenever there's a big systemic market meltdown, they tend to outperform every other currencies in the world. And it's exactly what's been happening so far. You realize on our platform that there's about roughly nearly 2% of offset in your returns, a reduction in losses since the end of Jan to now. And that's precisely what's in line with our expectations. Our backtests have shown that in the aftermath of a 10% or more drop in the stock markets, the dollar Sing move with a certain time delay within a month, that benefit of the risk reduction becomes even bigger. So we are very, very happy that the currency strategy is working. Having zero on our platform percent to the US, we've mentioned this many times, that you can have as Asia, ex-Japan ETF listed in the US, it has 30% exposure to China, 8% in South Korea, and so on and so forth, right? The US is just a denomination currency. It is a pass-through. It is not your exposure. However, we do have exposure, and it's by design. Depending on your risk level, the lowest risk has 40% exposure to US dollars. The high risk on our platform has 48%. This serves as shock stabilizer, risk reducer in times like this, precisely like this. So it's by design. It's not an accident, right? So in terms of currencies, we continue to expect a re-strengthening of US dollar in times like this.
Yeah. Yeah, and, I think that gives a little bit more insight again on that topic, because it always comes up, right? And the reason why we have it, we just explained again, makes sense in those times. It's when you do the short-term thinking again, of course, looking at short-term time frames, then it doesn't balance out, right?
Yeah.
But before we get to maybe some more questions, is actually so for StashAway, we do help people to. You mentioned dollar cost averaging, but how does StashAway actually help people, try to be on track and kind of that way?
And as you, if we recap, StashAway, it's a platform that helps you set goals. So we are goal-based investor. If you have a 30-year goal, retirement goal, if you have a 30-year time frame, you have a different risk level from a goal that has a shorter time. All this has been kind of an interactive process between clients and our algorithms. It's on the platform. At a more detailed level, we encourage people to have a plan, a monthly contribution. It can be any frequencies, right? It doesn't force you to do it necessarily. You can always change your goals. We recognize that you have to be flexible in life. But the thing is that we do help you set goals, have this plan to contribute monthly, right? It's precisely those mechanisms that's designed to protect you. And in times like this, it actually opens up opportunities to get into the market cheaper, right? It's all part of the features. Then the sophisticated algorithm that adjusts according to the economies is an additional protection. The X% of dollar exposure by design reduces risk in situations like this. The re-optimization, as clients of us, you probably realize, in December, we have re-optimized your portfolio, recognizing that the growth assets are relatively undervalued. Protective assets such as gold, they are undervalued and they are presenting better opportunities. And it's precisely these asset classes in times like this that's doing relatively better than the average stock markets. So we've done all this as part of our daily operations. You always have to be prepared for any situations when it comes to the markets. And as StashAway, this is a daily recurring process. So I don't see a surprise.
That's one of the main things we look at every day, right? Again, economic data that we talked about before, making changes. If there's a bigger change coming up, right? If leading indicators are changing, we will be adjusting to the market for you, right? So, you know, just to know, like we do cover these things at all times. And one of the things actually we had a lot of feedback about deposits. Do you want to just quickly mention before we see if there's any other questions? But maybe before that, you want to maybe mention this?
Thank you, Philipp, for this. We have heard you. There's been a lot of feedbacks that if you can improve the time from deposit to actually deploying your funds to invest, the process is now massively shortened. If you send money on any day in the morning, in most cases, you'll be able to be invested by the same night in US time. So we have made it a pretty impressive amount of a very short time from deposit to deployment. We're very proud of that fact. But of course, in some cases, maybe there could be also a situation where there may be bank delays between bank to bank, and it's not us. Then it gets deployed the next day. But in most cases, you should expect to now be invested in the same night when the deposits are.
So massively shorter time frames from now on, right? So this is I know we heard you, because that was a lot of requests we got on our support team, and it was we're pretty proud of that getting this done this quickly.
Yes.
So I don't see any questions at this point, but so we'll probably end it right here with that. But if you do have rewatch the video, or maybe you're watching it over the weekend and you're only just getting into this point, feel free to ask us. Actually, there's one question coming in.
Yeah, so from Aaron, by what time do you need to send funds on a day to have it deployed the same evening? Is that a cutoff time? I would advise that midday would be the cutoff time to be safe, to make sure that it gets deployed by the same evening. So yes, the cutoff time
would be noon, but noon. Anything before, of course, would be better. But noon will be the cutoff time, I would say, as well.
And I've also seen the comment on returns. It's time to clarify that we present returns in your account as a time-weighted return. It captures when and where you send the money, so it's a much more detailed kind of returns. You see a number. If you see a number that says, say, minus 5%. But then the number, say you have a $10,000 account, it says minus 5%. But you probably wouldn't find a loss of $500 because it's likely to be $250. The number, if you look at the $250 loss divided by 10K, is only 2.5. Why is that so? One clarification is that because at different times, because you contribute at different times, your capital is coming in. We account for the fact that your time-weighted capital is not exactly 10K, which is why the return could be actually bigger than the actual dollar loss or returns. So again, it's just it's the right way to present returns, but don't be surprised to see a smaller number when you do it yourself. It's just taking the profit and loss and divide it by your capital. Just want to clarify that. And
there's actually one question by Mark. Will you be looking into sending monthly statements earlier as opposed to the current timeline? Can you
feedbacks on that front as well? Certainly, we have been working on it. I can't say I don't have a clarity on exactly when we're going to be doing it earlier. But
we can get also our support team to give you an answer afterwards. So I'll make sure to speak with them.
We can follow. This is a question that we've been getting, and our teams are actually looking into it. It's actually been revamped, so I can't give you a definite timeline for when an earlier monthly statements will come, but it is certainly on the pipeline. We are working on it. Please be patient.
Yeah, well, that's good. Is there anyone else at this point? I don't see anything else at this point right now, but again, if you're watching this video over the weekend or next week sometime, please feel free to add some comments or even email us at support@StashAway.com, and we're definitely going to try to answer all of the questions.
Yeah.
It's
with that, thank you for dialing in.
And also give us some feedback as well if that's something like these kind of outreaches, if you like those or not. If you want to hear more about them in the future, let us know, and have a good weekend.
Yeah, have a good weekend. Don't forget to enjoy your weekend.
Yes.
Don't let the market stress you. Stay true to your plans. Do what we have always, the principles of investing, the laws of physics in money management does not change with all the situations. So just go have fun, relax, have a weekend, walk a dog, talk to your daughter, and stay true to your plans, and bid you have a good weekend.
Yeah. Thank you very much.